It has been a rough year to be an investor. Let's be honest. The S&P is down 20%, the Nasdaq is down 30%, Bitcoin is down 70%, and RK is down 75%. They told us inflation would be transitory. Not only has it stuck around longer than anticipated, but it's been much more severe than anticipated, coming in at an official 8.6% year-over-year read. But let's be honest, in all actuality, it's likely much more than that. Just by looking at gas prices, rent increases, and food prices, there's a lot of people that speculate that it could be even double the official reading. And right around this time in 2021, we are already starting to see the effects of inflation. For this reason, many people expected that the year-over-year increase of inflation would have peaked by now. This has not been the case. In March of 2020, the Federal Reserve dropped interest rates to near zero in an attempt to stimulate the economy as the world was reeling from the initial lockdowns of COVID-19. Americans received stimulus checks at a time when many people were out of work due to COVID lockdowns. Inflation is defined as too much money chasing too few goods. So you see the predictable effect of giving people free money at a time when supply chains are disrupted from COVID lockdowns. Again, too much money chasing too few goods. At this point, it's pretty clear that the Federal Reserve stimulated the economy too much and for too long by waiting too long to raise interest rates. This is how they fight inflation. By increasing the cost of capital, they can essentially suck liquidity out of the system. When interest rates rise, the cost of borrowing becomes more expensive. This makes purchasing goods and services more expensive for consumers and businesses. For example, purchasing a home becomes more expensive when mortgage rates rise, and financing growth for a business also becomes more expensive. When this happens, consumers spend less, which results in a slowdown of the economy. In general, rising interest rates hurt stock prices. If interest rates rise, the risk-free rate of return also rises. In other words, individuals will see a higher return in their savings account. This removes the need for individuals to take on added risk by investing in stocks, resulting in less demand for stocks. Which brings us to today. We are probably heading into a recession if we're not already in one, and stock prices are in the toilet. There's not much good news to go around. It has many investors asking, have we hit a bottom in the market, or is there more pain to come? Is it time to panic sell our investments and hide our money under the mattress, or is this the buying opportunity of a lifetime? In this video, we will discuss the negative factors that would need to be alleviated for the market to potentially find a bottom. We will discuss the feasibility of timing a market bottom in general. And at the end, I'll give my own opinion and I'll explain what I'm doing during these turbulent times. If at any point you decide you like this video and find it helpful, don't forget to hit the like button because that's what it's there for. Also, if you want some free stuff, feel free to lurk down below and check out the links in the descriptions. You can get free stocks, free crypto, also a free $30 to sign with Rakuten, a site where you can earn cash back on everyday purchases. Without further ado, let's get started. Alright, so what has to happen for the market to bottom? First and most obvious, inflation has to get back under control. This would indicate that the Federal Reserve wouldn't have to raise interest rates so aggressively. Some people even speculate that if economic conditions get really bad, the Fed could even cut rates. You often hear people say, don't fight the Fed. So many people see the easing of Fed tightening as the buy signal, but the market is always trying to price in what the future actions of the Federal Reserve will be, and it's very difficult, if not impossible, to predict exactly what's going to happen. The ideal scenario would be if inflation would come down without us having to go through a severe recession. The market is currently trying to price in a recession, so even a recession that is only mild could be seen as bullish. Additionally, we need oil prices to come down, and really commodities in general. This can go a long way in bringing down inflation. We have already started to see oil prices and other commodity prices start to fall. High oil prices are crushing because it really drives up the price of everything. Think about every truck, ship, or aircraft transporting goods, every piece of machinery running on gas, and every commuter filling their gas tank. At a certain point, people just don't have the money for it, causing a slowdown in the economy. When oil and commodity prices go down, then input costs can go down and inflation can cool. Another thing that would help would be resolution in the Russia-Ukraine conflict. The market hates uncertainty, and this is just yet another dark cloud of uncertainty hanging over the market right now. And of course, the Russia-Ukraine crisis is certainly not helping oil prices. Also, the easing of Chinese lockdowns would definitely be a positive for the market. Think about how many things come from China. These lockdowns have exacerbated the supply chain issues that we were already having and have added further uncertainty to the market. But at the end of the day, we can speculate all we want. Unfortunately, there is no magic buy signal that the market is at a bottom. There is no, all clear, come on in, the water's fine. when the market's at a bottom. I don't have a crystal ball, so I can't speak in certainties as it pertains to future movements in the market, but only in probabilities. And typically, by the time it looks like it's a good time to invest, you've already missed a big rally off of the bottom. Most of the best days in the market actually tend to occur during bear markets. But when they occur, people just write them off as being bear market rallies and just assume that the market will keep on going down. People have the tendency to believe that the trend will just continue, whether it be up or whether it be down. Typically, the market bottom happens in the middle of peak fear and uncertainty. The best time to buy is often when it seems like the worst time to buy, when everyone is panic selling their investments and prices are dropping through the floor. So it really does pay to be a contrarian. Hence the classic Warren Buffett quote, "Be fearful when others are greedy. Be greedy when others are fearful." The VIX is a measure of market volatility, and it tends to spike during the most fearful moments in the market. For this reason, many investors will use it as their signal to buy stocks. The challenge with this is, even when you think the VIX is peaked, it can always go higher. The good news is we don't have to perfectly time the bottom to be successful. And thank goodness, because it's pretty much impossible to perfectly time the bottom of the market. My standpoint is this: the market is down 20%. That is plenty good enough for me to be buying some stocks. I don't need it to go down 30 or 50%. It might. And if it does, I'll just continue buying. That's why keeping a good steady income is so critical. Having cash and income in a bear market makes you the king. Instead of fretting about the market, I would argue that the best thing we can do at this time is just to increase our value in the workplace, so that not only do we gain more job security, but we can justify having higher salaries to invest more money. The last thing I want to do is wait to invest, hoping that the market will go lower, and maybe it never does. In my opinion, that hurts worse than making a purchase and having the market go down immediately and then having to wait longer to see a return. The market is up roughly 8 out of every 10 years. So if you have to pick between being a perma bull and a perma bear, it pays to be a perma bull. At the end of the day, fundamentals can go out the window in the short term, but they will always matter in the long term. As long as I am staying diversified and buying good investments at good prices, I believe I will do well in the long term. Even if some turn out to be losers, the winners will be enough to make up for the losers. So I pay attention to the macro environment, but I don't stress over it, because you can't have a bad macro environment forever. Eventually, the issues that are beating up the market today will be resolved and we can move forward from there. But as stock prices go down, I feel even more comfortable investing in the market, because this is really the market de-risking. Think of it like climbing a ladder. The most dangerous part is climbing up to the very top, not after you've already climbed back down several rungs. The higher you are, the further you have to fall. So I'm not saying this will be over quickly. These kind of downturns can last years. What I am saying is that investing is not done on a daily, weekly, or monthly interval, but rather over the span of years. As Warren Buffett says, our favorite holding period is forever. The best investors are those that pick good assets and hold them for a long time. But if you found this helpful, consider hitting the like button and subscribe for more content like this. Again, also consider checking out the links down below. Currently down there you can get 2 free stocks of the Webull, potentially valued at $2,300, $30 with M1 Finance, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.